Okay, perfect. Panel 3, final panel. So thank you very much for all sticking with us, and hopefully it will be a good one. So integrity that scales. Let me first start with integrity in the carbon market. Is it as big of a problem as it was 3 years ago? So we've, 3 years ago, we've heard already a few times that the criticism was, at times, relentless. At least part of it was not necessarily wrongly placed, though, as Gabrielle has also mentioned. But to be frank, it was, at times, tough for lots in the market. Again, it's already been mentioned. But the market didn't collapse, nor did it shy away. In fact, here's what it produced. Methodology standards were tightened. Claims guidance narrowed the space for misleading corporate communication. Independent verification requirements have been strengthened. So the ICVCM's core carbon principles now set a credible threshold for credit quality. The VCMI's claims code gives guidance to buyers on what they can and can't say. Governments are setting clearer expectations. Buyers' knowledge has improved, and the market has matured. I could continue. So the harshest criticism in this market may have actually done it a favor. However, like any market, it's not perfect, and there's always still room for improvement. Let's take an example. Integrity costs money. Are enough buyers willing to pay what integrity actually costs to deliver? Whether that's rigorous independent verification, credible permanence mechanisms, or genuine engagement with the communities whose lands host these projects. You can't demand the standard and resist the price. And so that brings me to the central question for this panel. Integrity and scale are often treated as natural partners. Build integrity, and scale will follow. However, are integrity and scale sometimes in tension between each other? Can high integrity actually shrink supply, raise costs, slow deals? Or is it the contrary? So I would argue today the question isn't whether integrity matters. That debate is over, of course it does, and it's central to a well-functioning market that can deliver real positive change to millions, whilst also shifting the needle on climate change. The question is whether this market is on its way to achieving integrity and scale. So let's find out with this fantastic panel. So quickly, 60 seconds intro. Who are you, what do you do? Starting over with Tommy so that we're all on the same page before we dive into the questions.
Hi, I'm Tommy Ricketts. I'm the CEO and co-founder of GenZero. We're a carbon rating agency.
Hi, good morning. My name is Juan Carlos Arredondo. I am the Director of Knowledge, Policy and Advocacy at Abatable and member of the Technical Advisory Body for Corsia.
Hi, everyone. I'm Lu Hui, and founder and CEO of Carbon Stop. So actually, according to our name, we want to, firstly, we want to stop the carbon footprint for enterprises. And secondly, we are a one-stop solution provider for carbon management. Thank you.
Thanks. Hi, I'm Amy Merrill. I'm the Chief Executive Officer of the Integrity Council, where we set and enforce the threshold with the core carbon principles.
Thank you. And again, just to remind you, don't wait until the end to submit your questions, so we can go through them at the end. So, question one. So 3 years ago, this industry was asking, are nature credits credible at all? Now, as I mentioned, it's already been shown, a lot of work has been done to show the credibility of these project types. Standard bodies like the ICVCM threaten the threshold, rating agencies like GenZero scoring the risk. Governments, through Article 6 and compliance frameworks, are providing signals to the market. It's great, but it can also be a lot, and at times quite overwhelming for those who are new to the market and trying to understand them. So how can we make sense of this ecosystem? And almost more importantly, where should those who are trying to make sense of it look for credibility and integrity? So my first question, ICVCM and GenZero, Amy and Tommy. So hypothetically, we have a credit that is within the category that meets the ICVCM core carbon principles. At the same time, GenZero gives it a rating. How should a buyer, take a potential CFO, for example, trying to make a decision, use these two pieces of information, and what approach should they take? Now, just to add to that question, what if they don't match? How can we give the ultimate confidence to the buyer? So, Amy, please, if you kick us off.
Okay, so I'll try and wake everybody up as well, because this is the last session before the lunch break. If you're sitting at the back, you are also an integrity nerd, come and sit at the front as well. There's lots of seats. So, let's just take a step back as well, because the core carbon principles are the threshold for integrity across the market, and ratings agencies are providing a complementary bespoke service about rating a particular project, right? So these two systems, and if you don't know what they are, you know, nerd level has not been achieved yet. Core carbon principles is horizontal across the market, all sector types. Ratings look at projects which operate within the market in a given sector. And they're complementary because they generally are showing different things, right? We're setting the parameters for what is an investable carbon credit in the market, right? We talked, you know, many years ago, we had these problems with integrity. Nobody still thinks that's really a question anymore. But what the question is how do we then build the market from here? So, you know, 64% of CCP label credits have a BBB plus rating across all the agencies. And that's when the system we are operating in the CCPs was reviewing methodologies that hadn't been designed for the core carbon principles, right? So even the work we did backward looking into the market, the threshold we set is pulling out the same high quality project level that the ratings agencies are seeing. And now the market is designing methodologies to meet the core carbon principles, right? We're not in retrofit, we're in design. And so what we would expect is that even more credits that are coming into the market under newer methodologies would be both rated highly by the ratings agencies and capable of operating under a CCP approved methodology, right? So there's really a complementarity of tools now for, you know, serious investors and also less able investors to understand. And you heard in the last panel as well, you know, specific big buyers with specific systems. And one of the things that we now have in the market is the tools for the big buyers and the big procurers and the big investors, and also the tools for those that are operating at a lighter level of purchase, a lighter level of investment, where the core carbon principles are really helpful because they set the frame for what you should look at or maybe you don't want to look at, right? And so you start off by saying, how do I get into this market? Well, there's the core carbon principles. And then maybe as you get sophisticated, you turn to the ratings agencies to look at how they're working. So there's a really high level of complementarity now, and in a forward-looking market, we have the tools for scale.
Okay. No, thank you very much. And that sets us off really nicely, actually, looking at that broader overview. And so maybe to dig into the details, over to you, Tommy.
Yeah, so I'll start with some stats. So we've looked at the three threshold standards, PACM, CORSIA, and the CCPs. The CCPs, on average, have a higher median rating and have removed the lowest level ratings from the bunch. So in terms of the thresholds, we've got another threshold on the stage, they're doing the best of any role and trying to actually really address the fundamental issues. So, you know, very good start. Second one, just, you know, for everyone's benefit, future-looking supply, which is the majority of investment going into the market today. About 9 out of every $10 is spent forward, not spent in spot. One nice anecdote for you is of the, I think, 100 ARR projects that we have rated that are currently issuing credits, about 1 to 2 in 10 are A or above, so high rated, and about 70 to 80% are low rated. If you flip that round and look at our pre-issuance ratings, of which we've now done about 30 in ARR, it's the other way around. So it's about 4 out of 5 projects are A or above, and less than 15% are B, C, or D. So you're seeing not just the impact of 3 or 4 years of investment in infrastructure and systems, but also that being deployed through the value chain. And actually, you know, as we come to the last question, over the next year or two, you're going to see a much, much higher degree of higher quality projects coming through because the market has been solving itself. It's been given the apparatus to understand what good looks like. It's been given the incentives to try to get there, and then so long as the price mechanism follows and people can justify the prices, they're being given the financial incentive to do that. So to your original question, we don't often disagree, but got to make sure we have our own values. But we're also not trying to solve the same question, so it's fundamentally complementary. And also, if in the instance that we don't disagree, I think there's just one last point to make. There is the in-value chain analysis. Okay, so if you're taking a project through a value chain, you're a developer, you want to understand which methodologies or CCP line to go with, you're an investor, you've got your intermediary potentially, but most of your VVB, and then you're basically going to sell them. Right? That value chain is in value chain. Nothing that we do at GenZero is ever supposed to be included in that value chain. If you provide DMRV or you provide other things, how can I rate that project, right? Now, the market's been used to solving that linear value chain, of which the CCPs has a lot of integrity to. In more sophisticated markets where capital is allocated at a higher level, you have an entire ecosystem of diligence value chains, which is called reference or third-party analysis systems. And it's the interplay between the two that allows you to get discovery. And so what we have been trying to do from day one is third-party project-level information infrastructure. So we're not here to tell you what your baseline should be, but when someone asks you, how do you evidence that that's a good baseline, where are they supposed to go to, right? So I think the other thing to say is it's about, is what you're doing in the value chain of the project, and therefore you're trying to actually make it better, and, like actually on the ground, or is it an ability to actually assess it from the outside? And what was lacking when we entered 6 years ago was, and it remains a sort of interesting argument still, is just this idea of investor relations in general, right? Having to take accountability to people, and it might be annoying and it might be frustrating, it might add cost to your process, but the difference between getting $500 million of investment and hundreds of billions is the information infrastructure and your ability to address those questions. And so I think what we're both trying to do is actually beef that up, but they are fulfilling slightly different functions.
No, thank you very much. Definitely clears it up, and I think it comes into this whole conversation of sort of the non-binary as well, right? This or that. It's not this or that, it's this and that, and I think that really helps to clarify the complementarity of them both. Thank you very much. So I want to move now to abatable and carbon stop. Juan Carlos, Liu Hui. So we've heard from the standard and the rating now, bringing it back to the market. So you're both closest to where the capital moves and the procurement decisions are, the deal structures and the data behind those transactions. What are buyers actually using to make these credibility calls now? And do you think that what they're using is keeping up with what the integrity infrastructure is trying to deliver? And then Liu Hui, just whilst you're answering yours, I'm quite keen to hear from the Chinese market perspective as well, from where you guys are specialists. So please, over to you, Juan Carlos first, and followed by you, Liu Hui.
Thank you, Dan. Buyers are looking into high integrity. That's for sure. I think that what we are seeing in terms of transactions, issuances, retirements, all of that has been happening over the last 5 years, there is clearly an indication that we don't like too much carbon credits that represent mitigation that happened 15 years ago, and the market is preferring the most recent vintages, the most recent mitigation that has happened globally. Now, within that, of course, it depends on the type of buyer that you are or the type of market that you are participating in. If you are an airline that has international flights, yes, you will be looking for CORSIA units to comply with your compensation requirements under CORSIA. However, you may be looking for a different type of credits if what you want to do is help your customers offset their flights. Similarly, we heard previously from different companies how they are approaching the market, and in that process, they are defining certain parameters that guide, even science-based requirements that define what they want to source and how they want to claim the use of those credits. And what is important in this process is precisely what Amy and Tommy have been highlighting, the importance of defining thresholds and following through in the application of the requirements that are associated to those thresholds. If we take, for instance, the eligibility and approvals that come from ICBCM, we know that ICBCM and the core carbon principles tells you what is happening at the standards level, which standards have set up stringent enough requirements for them to be qualified as eligible under the core carbon principles. But also those standards, what they do for them to have carbon projects registered with them, they have defined methodologies or protocols that are the recipes that you follow for a carbon project. In that process, ICBCM has also scrutinized methodologies as applied by the different standards, and of course, what happens in practice on the ground. But that is not enough. What comes later is a carbon project that actually follows those recipes, those protocols, those methodologies across different project types. And in that process, neither ICBCM nor CORSIA are looking at the specific project or the project developer. At that moment, precisely the type of due diligence that has to come to understand the track record, the performance, the practices of the project developer, and also what is happening on the ground with a specific project, it demands for you to know a little bit more about them. And that's where the ratings agencies come. No, they bring an important component in terms of scrutinizing all the way from the standard, the methodologies, but also the geography, the practices, and the ways these projects are executed. And even if you take a further step, if you go still beyond that, the buyers, either a country or an airline or a corporate buyer of any sector, they also have, to some extent, when they can, due diligence teams, they also look into what is in there for them to have certainty that whatever type of claim they make around those credits actually represent an accurate representation of that mitigation. So in summary, all of these views that we have, it's complex, yes, it's not easy to understand, but it's clearly something of a complementary nature.
Okay. No, thank you very much. And then something I'll come to later on is obviously there are so many layers of due diligence now, and so where is that burden? But we'll come to that later. So Lu Hui, please, over to you.
Yeah, okay. From the market level, I would say, I think there are three main drivers for companies to participate. I think number one is compliance driven. Number two, supply chain driven. And the number three is about reputation driven. And if companies want to purchase credits, so I would say there should be some priority. So I would rank them, first one as risk. Number two, recognition. So all credits, all projects should be recognized by, for example, like ICVCM, the principal, or rating good level at B0, right? And number three is about number one. Last one I think is a cost, right? So because companies they are paying money to get credits, so they are less sensitive to cost if they understand the risk. So in the real world, still we have so many companies purchase very cheap credits only because they don't understand the risk. They don't understand how risk will influence their business, right? But in China, there are several cases. I can give you an example to share. They perform very differently. There is a sportswear company called Anta, whether you know them. They are top three in the world. Number one, Nike. Number two, Adidas. Number three, Anta, right? And in 2024, Anta came to us. They want to understand the carbon footprints of their 100 products and make some pilots to make the products to be carbon neutral. And there is a very specific case. It's a uniform for the China delegation for the 2024 Paris Olympic. They want to put that uniform to be carbon neutral. So, it's very challenging. You should fit for the Chinese regulation for carbon credits, and you should also satisfy with the international environment. So, at last, we decided to find those materials to reduce carbon emissions to about 50% of carbon footprints at last. And for carbon offsetting projects, we made the mix. It's a mix of gold standard and Chinese CCER. Gold standard nature-based projects and CCER nature-based projects as well. So make it to satisfy both principle and the standards from the international society and also domestic world. So this case creates very good impact for the company. So at last, in 2024, they have a shop in Shanghai. If you got any chance to visit Shanghai, there is a shop called GenZero Mission Shop. They didn't call it carbon. They didn't call it zero carbon shop, but called zero mission. So the mission is to achieve carbon neutrality. That's a very clever way. So I would say, basically in China, most companies are more data-driven and more compliance-driven and more, claim sensitive. So they are not only purchasing carbon, they are buying confidence.
Okay.
Thank you.
No, really interesting. Thank you very much, both. And I guess that's where companies like yourselves are great, because they have the tools, like Amy was saying, the tools for large companies and small companies to make these informed decisions. So let me move to question 2, and this one is, I don't know if anybody did move forward. Amy asked for the integrity nerds, but this one's for you. So let me start this question by borrowing an analogy from another market. Regulators, they don't set interest rates because there's one scientifically correct answer. They weigh different risks, objectives, such as price stability, employment, growth, etc. And they make a calibrated decision. Is something similar happening here? And perhaps some of the hardest questions in this market actually come down to policy ones. Permanence, risk, leakage, counterfactual baselines, they may not be purely scientific choices, but perhaps our best predictions about the future. And increasingly, they're predictions that regulators are also making. And on top of that, perhaps because of that, is the bar just moving, or is it being set in multiple places at once? So first, I'm going to come to abatable and carbon stock. This is for you two again. Let me start with the demand side. In your experience, do buyers actually understand the core principles of integrity, like permanence, leakage, additionality, among others, or are they outsourcing that judgment to you? And to use my same analogy, do buyers understand what the regulatory body is using to calculate them, or is it just accepted? And it isn't taking anything from the buyers. It's a very complex market, and yeah, I'm quite keen to understand from you two.
Sure. Well, the different buyers have different strategies for engaging the market and different reasons of why they are sourcing carbon credits. In principle, many of them actually care about the integrity of what they are buying and the quality of where this is coming from. Do they need help in that process? Sometimes. Sometimes not because they don't know, they do not understand what additionality is or carbon leakage or so on, but sometimes the teams are small. No, the sustainability teams, they have 2-3 people who may be very knowledgeable about all of these attributes, requirements, etc., but they may not have the time to go through everything, particularly if what they want to source is hundreds of thousands or millions of tons of carbon credits in a certain period of time. So because of that, they may rely on what exists in the market, they may go and check ratings, they may ask questions, and yes, they may rely on someone who is specialized to provide that guidance. But in a few cases, particularly very large corporates, they do have the teams, they do have the science, they do have the resources to even set up their own programs that run all of these due diligence across the standards, the methodologies, the protocols, the projects, the project developers, the geographies, the project types, everything in a very sophisticated manner. I think the key message on this, Dan, is it's important to understand the different lenses that apply for understanding integrity in the market. Is good for any buyer of any size to take a little bit of time to read what the core carbon principles mean, to realize that every single carbon crediting program follows exactly the same principles of additionality, permanence, avoidance of carbon leakage, double counting, everyone. The difference is in the specifics of how they apply or what type of measures or procedures they put in place for you to demonstrate that is the case. So I will stop there.
Okay. I would say, for the most like C-level executives, probably they don't want to be the carbon scientist, right? So usually they effectively outsourcing the technical stuff like permanence, leakage, additionality to the platforms like us. So at Carbon Stop, actually, we work with every year we work with over 100 companies to purchase the high quality and high integrity credits for them, and it includes those domestic buyers, including as I mentioned about like Anta, Here House, ED, which is the largest dairy company in China, and also China Southern Airlines. to purchase the carbon credits to offset the carbon emissions from other travelers. And also, we have several international ones, for example, like Mercedes-Benz and the Tetra Pak, because they have Chinese offices and also factories, also need to offset their carbon emissions. So basically, we provide professional services for those companies, and for different companies at a different stage and different time, they have very different principles or standards to choose a right project to offset. So actually, last year in July, we launched the portfolio product called CCT. The full name is Carbon Stop Carbon Town. So to satisfy those different requirements of different buyers, someone they are very cost sensitive, and the other one are quite risk sensitive. So we should find a portfolio product to fit all the requirements from the market. And actually, I want to take this opportunity also to send an invite to all of you, because last July, in our GCMC conference, it's called Global Carbon Management Conference, we launched this CCT. And actually, every year, in Q3, from July to September, we will have GCMC conference annually. So this year, I would like to invite all of you. And in the past, from 2022, we invite the top 100 and the top 500 companies in China, the ESG leaders and the sustainability leaders to join and to share the insights. So I would like to invite maybe some of us to come to Beijing and in Q3 and to share the insights. And this opportunity is quite essential to get the international perspective and also from the Chinese local environment. Yeah. So lastly, I would like to say, if for the deal, if we consider about the enough reputational risk, and then the buyers won't walk away immediately, because if we consider enough about the risk and the potential. Yeah, thank you.
Thank you very much. It's interesting to see how you're working with these companies and these corporates, actually trying to make these positive commitments. So appreciate that. So let me move over again to BeZero and ICVCM now. So some actors are concerned that we're building an integrity market that's so demanding, only a handful of well-funded projects and programs can meet it. Only a handful of buyers can afford it, and only a handful of jurisdictions can deliver it. Or in other words, in trying to eliminate bad credits, we may be accidentally eliminating or squeezing out a large portion of very high quality credits from the market. So what's your take on this? Are we building for perfection or building for scale? And what does it mean to actually do both? So please, Tommy, if you kick us off.
Well, I think two things. First point would be we built for scale, I believe, in the broad church Antonelli period, where it was about methodologies and inclusiveness, and concerns about the performance of these credits is basically what led some of us to be on this stage. So just thinking about inclusiveness in the activity is certainly not enough, basically. The second thing, as I say, is the majestic heterogeneity of this crazy little space we work in has about 100 cost curves for different activities. So you talk about interest rates, there's the classic line of, you can't have one political union with 20 different interest rates, but you can also have the EU. What is the cost curve of the carbon market? Well, it depends. It depends on what activity you're supporting. Avoidance credits can be high integrity and very cheap. Removals credits can be not very high in quality and very expensive. So it's a slightly weird way of looking at it, right? There's not one unified cost curve, and if there were, it can be a power market. We can all go home and basically just beat the marginal cost of supply. We're going to transitions credits later, so we can talk about that event. So that's not really the right way of framing it. I think the idea is for a given activity, can the value of the project's price times volume. Typically speaking, higher integrity processes will require some curtailing of volume. But you're trying to force the market from saying, I can supply at $2.50 and I can sell it at $4. So do I care about integrity? To saying, what if you do build lower FNRBs into your calculations and a higher quality, cook stove methodologies with better sampling data, I need at least $12 to $15 to break even. What are the buyers that are going to reward that activity? It's very different from a marginal cost of $1,000 for a direct air capture and whether that's actually efficient or not efficient. So I think that the cost of a project is about the marginal cost of delivering it, and then essentially the parameters under which you're delivering it, the extent to which those are going to affect the volume should be determined about with the price, which is why every year we try to do this price ratings correlation piece, which basically is trying to reinforce the idea that if you take more conservative estimates, you will get a price correlation. And last year in MBS ARR, it was 90% per ratings notch. That's not trivial, right? When I first started, it was 0, the correlation. That might have been the ratings, but it could also have been the market. So yeah, that's what I would just say. It's important to move beyond that conversation and say, look, a cook stove is not the same price as a mangrove restoration, is not the same price as a landfill gas. They all have different cost curves. Within those cost curves of production, higher integrity typically means higher granularity of analysis, which may mean slightly more expensive. But then the problem is, you can't ask for higher integrity and then say, I can't afford it. So, I'd flip that back and say the market's solving to what buyers wanted. The buyers now need to say, are they prepared to pay the money to add that solution?
Okay, thank you. No, I appreciate that. And so you kind of already answered it, but then, so how do you want the conversation, and you kind of mentioned your annual report, but how do you want to see this conversation progress that's actually helpful? Because this can be sometimes heated, right? This conversation, this argument in the market. So how do you want it to progress to be helpful, like changing that narrative, for example?
I think there's two ways to make a purchasing decision. What's the best quality at a given price, or what's the best price at a given quality? Just up to you to decide which one of those two ones you want to answer. If your budget's $5, there's much better and lower quality stuff at $5. If your budget's 50, same things there. That's what I would do. Just go back to principle. The carbon credits are about paying for your externality, and they have lots of other co-benefits associated with it. 1 cent is better than 0. It's literally infinity more than you're paying otherwise. So to us, if you're paying for your emissions, that's pretty much the 80-20. Then it's a question of where you spend the money and how you do it.
Okay, thank you. Appreciate that. Amy.
Yeah, I mean, Tommy's given some really, really good examples there of those kind of discussions around, the price and the sectors. I think the other thing to remember is that we're trying to do something here. We're trying to get finance to flow to do mitigation that otherwise doesn't happen, right? So we're trying to balance a load of different interests, just like we were when we were agreeing the Paris Agreement and the cooperative approaches that all of this connects into in interconnected markets under 6.2. And I think when we're talking about this, a scale or integrity, they are not misaligned. There has been a market recalibration with the core carbon principles and the introductions of ratings to bring a better standardization and comparability so that we can bring those markets into the shape they need to be in to be able to attract serious investment, not just from really big bespoke buyers and really big bespoke investors, but to get everybody out of doing nothing and into corporate action. And I think it ties back to the last panel, which is about the need for policy support for that. There are, so if you have governments saying corporates manage your emissions, and you have governments meeting their NDCs and setting ambitious NDCs, you start to create the conditions for the scale, right? Fundamentally, the scene is set for that. And what we have been doing in the ICBCM is building the interconnectedness of markets so that when you're choosing how to approach what your comfort level is as a buyer, you're choosing from a solid base across all the sectors, so you can get to all those ands that are the beyond binaries, you know, the ands, that nature and, you know, tech, reductions and removals, and, you know, mitigate in your business chain and invest in carbon credits. And so I think we all know that if you take different project types, some of them will deliver a smaller scale of volume when they're operating within the parameters of the core carbon principles, perhaps because they are more focused, as Mark was saying in the last panel, on particular benefit sharing arrangement, indigenous-led projects and those kind of things. And that it is okay to have, at the other end of that spectrum, high integrity, really reductions-focused, scaled projects that are operating and bringing a lot of volume. So, you know, you have a horizontal mix of high integrity, as Tommy was talking, you know, about different sectors. They may have different price points, but we're now moving beyond that transition point where anyone's trying to say that you have to choose one or the other into that sort of portfolio management. And it's always been the case that you manage a portfolio with a set of different types of projects and a set of different price points, either to deliver to your customers or to manage your own costs. So, yeah, I think it's you know, the sort of the broader picture of that, you know, going right up to the international level, reinforces that when you're doing everything at high integrity, you also are actually enabling that specification, that diversification within that range.
Maybe then, if you allow me, real-life examples of everything that we are talking about. Because the notion of a portfolio is very important. So it's not that high quality is this project and low quality is that project. Buyers go for portfolios. No, they also try to diversify the risk of being on the front page of a newspaper, right? And at the same time, no, as Tommy mentioned, depending on who they are, they may go for a certain price and whatever quality they can get, or vice versa. They are specifying quality or integrity and at whatever the price with a certain budget. So we have, as a carbon procurement and market intelligence company, we have had clients that come to us telling us, I have $10,000. That's it. Help me reach some of my targets and help me compensate my carbon tax. What can I buy with that? And the secret on that is going to the market to as many project developers that may exist, some of which have units that have the CCP label, no, small volumes that can fit into a portfolio for that client, but also choosing some emissions avoidance units from projects that are not using a CCP approved methodology, but that we know that the project is transitioning to a methodology that will get or that is already CCP approved. So creating this type of portfolios allows the client to have certainty that whatever they are buying helps it to achieve that target. And then we have, on the other side of the spectrum, for instance, airlines who have not retired their units but are coming to ask, what can I buy, knowing that is CORSIA eligible? If this is a compliance system, give me the cheapest option or the best price that you can find. And then, again, is surveying the market, looking for what exists that complies with that specific requirement of the client. And the most sophisticated buyers that don't have their teams that need support, they may come with 10, 20 million US dollars of budget for sourcing of units, asking, what can I get with this at the highest possible impact, with the highest possible integrity, and in a manner that if I can integrate, for instance, novel activities, CCP approvals, CORSIA eligibility, all of these things in certain regions where I operate. No? Somewhere in South America, something in Southeast Asia, for instance, and the US. So the challenge really is in this process is maintaining this notion that it's not just a single shot. You always look at this from a portfolio perspective. You have to be aware of all of these different complementary offerings that exist in the market to understand the standards, the methodologies, the project's performance, the project developer, for the buyers to actually engage in a meaningful manner and in a manner that responds to their needs. Otherwise, we are just perpetuating the notion that if you want high integrity, you just have to buy expensive, which is not the case. And if you want something else, you will get cheaper options. Let's get rid of that notion.
So they come to you with a budget, and I guess you essentially have to then walk them through to find their risk appetite as well, I assume, right? Because I guess everybody's changes, and they might want the best thing in the world, but actually their risk appetite doesn't allow them to do so. So I guess you have to walk them through those steps as well to kind of essentially figure that out. Right, so final question. We'll stick to time. I appreciate lunches after this. So to everyone, so how do you see the market moving in the next 2 years? And how different is that from what you'd like to see in the next 2 years? So give me what you think are the top, let's say 2 things with the time we have, missing today that would unlock those multi-million-dollar deals plus in nature. What needs to change, who needs to move, and how soon? After all, integrity frameworks are designed and they're meant to move capital. So let's start with Amy and work our way to Tommy.
I think we want to see enabling policy support in countries to enable corporates to know that they have the ability to act with confidence on all of the emissions in their decarbonisation process. I think that will be really helpful, because I think in many corporate decision-making processes at the moment, doing anything beyond the essentials is really difficult. And the macroeconomic world being what it is, I think we need to recognise that policy, that enabling regulation and policy support, whatever it looks like from governments, is meaningful in the next 5 years, as we transition towards that, that goal of carbon pricing as set out under the Paris Agreement of every ton in every economy being under some kind of target. And then, perhaps the second thing, a bit more of a nature focus, is to realise that we've come to that level of nuance about the discussions in nature, and we're now moving forward. And to help everyone collectively to continue to move into the path of managing risk rather than being scared off by risk, and understanding that we have emerging tools to manage permanence risk, and that ICBCM is doing a lot of work on permanence risk and on innovative approaches. There's lots of initiatives. There's permanence trust, there's insurance, there's revised ways of buffer pools with stress testing. There's lots of different tools for that risk, and it's a risk that we are getting better and better at managing with DMRV, and that conversation can now move forward with confidence rather than being stalled at the gate.
Okay. So in the future, so to scale the market, I would say we should stop letting perfect to be the enemy of good, right? So what we are missing today, I think there are two things. The first one is about policy certainty. So the buyers, their fear of uncertainty. So we should make that stable for the policy. For the next few years. Number 2, I think we should lower the cost of integrity. The rigor costs money, and we should find a solution. We should leverage, for example, the advanced MRV, and also the technology, and even using AI to reduce the cost of compliance. And high integrity should not be like a luxury for those well-funded companies. It should be a market standard, right? So my final words would be the market scale. The market does not the market scale not because we lower the bar. It scales when we make the high bar to be understand, easier to verify, and easier to act on. Thank you.
Thank you.
Well, what we have heard in previous sessions, and I think is what I would expect in the next years, is this emerging convergence between compliance and voluntary carbon markets. We already see that in emissions trading systems and carbon taxes that allow you, to provide you the flexibility to use carbon credits of different types, with certain specifications on the side of the countries for you to comply with your obligation. CORSIA itself, it's that type of market, is regulated by the United Nations by way of rules set up by countries, but relying on credits that come from voluntary, or mostly carbon credits from voluntary standards. And the same is happening in the voluntary space, that as this type of convergence is happening, a new level of scrutiny is coming into the market. The standards are developing more stringent requirements, are updating their methodologies, they are generating new methodologies for novel types of activities. So if all of this continues, that possibility of convergence can be there, and then we could see scale coming through.
Cool. I'm going to take it a slightly different route. I think 2 C's. One is consolidation, and the other one is it's coming. In Marshallian terms, we're basically between a contraction and a trough in the carbon market. Now, what tends to happen in those times is a lot of innovation, but also consolidation around the areas that are improving and are actually making work, or the business models that are working, and the ones that have been generously supported by GenZero, who are trying to find their feet. That's what's happening right now. Now, in a period of consolidation, there's a lot of economic irrationality. There's too many intermediaries chasing too few purchases. There's too many suppliers trying to provide MRV and solutions into too few things. Right now, the denominator in the industry is too big. This year, there will be a lot of consolidation, and that's a good thing, because it will mean that the business models and the technology and techniques that survive are the ones that were meant to survive. The second one is it's coming. As I mentioned before, there is an unbelievable step change in the quality of work that's coming through pre-issuance, our pre-issuance analysis sort of business versus the stuff that has been in the market for 10 years. So I would maybe finish with where Amy and I were just starting is, I don't think the integrity problem is finished. I think it is sufficiently solved to a point where it is no longer the main talking point of the industry. Whether it's policy or whether it's demand stimuli, which basically one and the same thing, that is where the attention needs to be going to, because actually after 5 years and many a speciation and business model, I think we're actually getting there in terms of solving those issues.
Brilliant. No, thank you so much, everyone. That's been, really interesting. I mean, I think there's a lot to unpack there. So much so there's no time for questions. But if you do have the questions, you should find these guys afterwards. But no, thank you very much. We've seen how the complementarity of these actors can definitely benefit the market, and actually they're tools to be used by big companies, small companies, and governments, because as we often see, capacity is an issue. You might have 2 incredible people working in a company on this, but there's only 2 people working in a company on this, and it's the same with governments. So the tools are there, so we should use them to understand that high bar and not be scared of it. So thank you very much, everyone. I'll finish there, and I appreciate you all guys for coming out again today. Thanks.
Thank you.